Hello, everybody. So we're entering another period where I think I'm just gonna go on a walk, close the apps, and of course these periods, we are very much used to them because the 2020s are a lost decade. We've had dark gray swan after black swan after dark gray swan after black swan after black swan after dark gray swan. This is all we've had. Today might be known as Bridge Day. Bridge Day, perhaps a repeat of Liberation Day. You may remember Liberation Day, April 2nd last year. I guess Bridge Day will be April 7. But we get market wipeouts to the 2025 grade perhaps every year now. This is the market that we're in. We need to accept that this is a lost decade for investing, and I have accepted it, and that's why all of the decisions that I make, they are for 2030 and beyond, past 2029 to be specific, when we will have predictability. Because we can't have predictability when a tweet can literally ruin thousands of hours of fundamental analysis, ruined by a tweet. You know, and the case in point, of course, today is Tesla. Tesla really hurts, big position for me, so it really hurts today for me. Down 30% from 4 months ago. Entirely ridiculous. But, you know, that's because the market doesn't focus on fundamentals. The market is not focusing on fundamentals. Like FSD solved. Hello. Like robotaxi coming. Hello. Terafab. You know, and we're getting SpaceX to pay the entire Terafab. I mean, just so much positivity going on Tesla. So much fundamental goodness going on with Tesla. And excuse me to put an ounce of reason in there, but if oil actually goes to 150, if Bridge Day actually happens tonight, and oil goes to 150, wouldn't this sell a lot of Teslas? Which is the only man left standing in the United States as far as electric cars go? Like, hello, it's still $6 or $7 for a full tank of quote-unquote electric gas. Teslas are still very, very cheap to operate. The cost to operate a Tesla has not changed, right? It's still about $6 or $7 of electricity for 350 miles. $6 or $7 of electricity, right? I'm sorry. I mean, we forget the 10x innovation from Tesla, which is electric cars are much cheaper to drive. So if oil goes to 150, as far as I'm concerned, electric car sales are going to go through the roof. But the market, of course, is dumb. Is not pricing that. Correlation goes to 1. Correlation goes to 1. Everything crashes. Everything goes to 0. And by the way, even if you look at stocks that have fundamentally good news, like take a stock like UNH, follow the good news that UNH had yesterday. They're allowed to raise prices 2.5%. It lost half its gains that it had yesterday in pre-market. Half its gains. Could UNH end up red today? It could. It could, because this market does not trade on fundamentals. Case in point, HIMS. HIMS, yesterday we were up about 6%. I couldn't find the chart. You know, it's historical stuff. But we were up about 6%. Today we're down 6.05% as I look at my screen right now. So we dropped another percent. So up 6% yesterday, down 6% yesterday. This pattern makes absolutely no sense. This market has killed the fundamental analysis for the time being. Fundamental for analysis for the time being is dead, as far as I'm concerned. It's ridiculous. It's entirely... And what can we do? Well, the problem is we can't do much except sit on cash. Because this time of uncertainty is tweet-based, and you cannot predict a tweet. Should you hedge? You want to hedge? You want to sell calls on your position, get some cash, hedge in case we have more to the downside? You want to cap your upside? Well, guess what? Good luck if you do that, because one tweet could send the markets up 10%. And we saw that during Liberation Day. We had the wildest intraday swings in the NASDAQ ever in the history of the stock market. Like the biggest swings in the history of the stock market of 2025. Are we going to have such another day? A tweet could trigger such another day. You want to short? Same issue. A tweet could entirely blow up your trade if you short. Like a tweet can send the markets up 10%, down 10%, and you can't predict when that tweet comes. So, frankly, I only see two ways out to this madness. One way out, which I think deserves a lot of attention, would be synthetic stocks, like reusing prediction markets to bet on things like revenue growth. Let me bet on revenue growth. Let me bet on new product launches. The problem is, the market is entirely nuts in the real world, but on these prediction markets, I have a feeling the markets would be much more rational. And for a highly predictable firm, they probably wouldn't pay you out very much if you predict the revenue right, because the companies are not broken. It's the financial flows under the capital market that are broken. It's the money flows, the buyers and the sellers, the balance is broken, but not the stocks. So that would be one way out. Another way out would be to simply rent Saylor's diamond hands. Michael Saylor said multiple times, I'm a very special type of man because I lived to see my stock drop 99.9%. And I'm back, right? Saylor's diamond hands. And perhaps Saylor created the perfect instrument for people who want to rent these diamond hands of Saylor. It's the stretch. Stretch is at 100. Stretch is flat, and it pays you 11.5% tax deferred. So what does that mean? I mean, the return 11.5% tax deferred, probably very similar to what you would get, for example, with the Nasdaq by paying full tax, depending on your state, right, and your tax bracket. It depends on your tax bracket essentially and your state. But if you happen to live in a high tax state, stretch return could be very, very similar with, as Saylor says, 1 penny of volatility, and then maybe come 2029. You decide whether the craziness is going to continue or not. Either way, the 2020s are a lost decade. I'm going on a walk. This is just so bad. Anyways, this was not financial advice. This is not investment advice. This is only entertainment. I'm hoping you were entertained. Please please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.